Hello and welcome to the Currency Exchange, NatWest Markets FX podcast, where we break down the major themes and events driving currency markets this week and the week ahead. Today I'm joined by Paul Robson and Brian Daingerfield, who are two heads of G10 FX strategy here at NatWest. It has definitely been quite a week, with even a lot happening in the few minutes before we went to broadcast. But Paul, I'm going to come to you first. We had today, earlier on Thursday, the Bank of England policy meeting. What were your main takeaways from the policy decision?
Thanks very much, Eimear. I thought it was a really interesting market reaction for a policy announcement, which was to leave interest rates on hold. The focus going into the meeting, I think, was twofold. One was on the vote count, but within the vote count, to what extent that would set up a possible rate hike at the September meeting, or whether it would be pushed back to November. And then around that, just the sort of formal guidance, but also the views of the individual committee members. In terms of the vote at the first cut was actually a little bit more hawkish. Market expectations was for a 7-2 vote, so 7 members of the MPC voting for unchanged rates, 2 voting for a hike. Was Green and Hugh Pill, the chief economist. In reality, the vote was 6-3, so an extra man voting for a rate hike. So that would give it a slightly hawkish hue, if you like. But actually, the market reaction was dovish. So markets became less confident that the Bank of England would move rates at the September meeting, more confident that that first rate hike comes in November, but overall took out 10 basis points of easing. So, for example, 10 basis points off 2-year rates. And I think that was because the underlying details were more dovish, a sort of dovish pushback on market pricing, particularly from Governor Bailey. He was talking about the disinflation process and that he still wants to wait for second round effects, and there was very little evidence that was happening. And I think for the MPC generally, they do remain cautious, and it feels like there's still quite a high hurdle for 2 more voters to shift from wanting unchanged rates to hikes, Eimear Daly, for example, and Bailey. In terms of the outlook for the policy rate, pricing isn't that now dissimilar from our own house view. So the 25 basis point hike at the November meeting to 4%, and then another in Q1 of next year. Markets have got 20 basis points between now and the November meeting, but 45 in total by the end of next March. This meeting was all about sequencing, I think. It was about whether they would go in September or November. And I think overall, a slightly dovish interpretation. So an interesting one. But I think it's very much come back at the end of the summer and see where we are at the September meeting. But they will have a lot more information about whether we're getting second round effects from the oil price shock in November. And that remains the House view, as I've just noted.
Yeah, I guess uncertainty still remains extremely high with the Middle East situation. I guess, given the kind of dovish market reaction, does it change your sterling view at all?
Not really. I don't think sterling is an interest rate play at the moment. Actually, the currency was only a little bit weaker to the what turned out to be a dovish at the margins Bank of England meeting. There were bigger moves in rates around, I think, what we heard from the Fed, and it's going to be super interesting to hear what Brian makes of what we heard from the Fed on Wednesday. I still think sterling is going to be about the risk premium around politics and fiscal policy. And I continue to hold to the view that we'll get more information about that in September, but crucially into the October budget. Now, the government will want to pre-position any changes in spending and tax and borrowing in the weeks and even months up until that event. So I think sterling might find the going a little bit harder once we get back from the school holidays and markets become a little bit deeper and people's appetite to look at the evolving situation around fiscal policy. Because if the government does want to try and regenerate, energise growth in the UK, they might think it's fiscal policy. And if they do think that, then they're going to have a conversation with markets. And as we continue to maintain the marginal buyer of UK government bonds are international investors, they're price sensitive, they don't have to buy gilts, they can buy anything they want. So that's when risks around the currency grow. So we have a relatively flat outlook for sterling euro, but we still maintain that sterling dollar will be higher by the end of the year, but we still think that's a dollar move rather than sterling.
Well, one currency that is certainly moving in the last few minutes as we went to record was dollar yen, which showed a suspicious move lower within the last few hours. Brian, I have to come to here. I mean, it looks a lot like MOF intervention. Can you call it at this stage, or what are your thoughts?
Well, this certainly looks like it is MOF intervention. Just for context for listeners, we're recording this on Thursday morning here in the U.S., so we're literally in the process of MOF appearing to be intervening in the currency post FOMC, but before the Bank of Japan decision tonight, which I think is important as we think about the timing here. But this does look like intervention. It certainly feels that way with the scale of the move, with dollar yen falling at one point, I believe, looks like testing 158 on the downside from as high as 163 and above at the beginning of today's session. The timing of this is very interesting because, as I mentioned, this is after the FOMC decision, which the market interpreted as dovish. I'm happy to sort of touch on that in a moment. But it's before the Bank of Japan decision. And I think there's two strategies for FX intervention that, from a broad perspective, that MOF could take. One of them is trying to prevent weakness by buying the yen at moments where the yen is weakening against the dollar and global currencies. Another is trying to buy yen when it is in the process of strengthening against global currencies. The former is useful for when you're trying to counteract a move you believe is out of line with fundamentals. But you might be swimming upstream when you're doing that. You're buying yen at a moment when the market is trying to sell it for some fundamentally justifiable reason, potentially. The other side is maybe less expensive because what you're doing is you're pushing, instead of swimming upstream, you're swimming with the current. If the current is moving dollar yen lower, you're maybe giving that move a bit of a push. This move clearly appears to be in the latter direction, because the yen was not facing specific pressure today leading into what looks like intervention. If anything, it was stronger both on crosses and against the dollar from where it was at the beginning of the week. And so this certainly feels like the MOF may be trying to take advantage of strength to try and flush out speculators. The other notable development, as mentioned, is that this is before the Bank of Japan decision. So there is very significant event risk in the currency coming up in the next 12 hours here. The decision itself is widely expected to be a hold in policy rates. And, we won't talk too much about the Bank of Japan here because by the time you're listening, we'll have had the decision that will be public knowledge. But the timing of this intervention is curious simply because if the Bank of Japan were to deliver something dovish, then it could offset some of the gains in the currency that were achieved with this intervention. And so it's particularly notable because of that they seem to be moving ahead of their local event risk in favor of maybe trying to take advantage of some of the event risk gone by, with the Fed and the market's interpretation of that meeting being dovish and generally translating into a weaker dollar. Some other considerations here. We're always thinking about fiscal policy and how the currency weakness filters into fiscal policy. The Takaichi government confirmed this week what we've long expected, which is their intentions to reduce the consumption tax on food from 8% down to 1%. That's one of the hallmark fiscal stimulus plans that Takaichi had campaigned on, is reducing the consumption tax significantly. That fiscal stimulus comes in addition to other fiscal stimulus packages and some other fiscal pressures coming from not just higher yields in Japan, but also from maybe concerns around potentially higher military spending, given everything happening in the Middle East, and also supplementary budget because of previous efforts taken to reduce the strain on individuals and businesses from higher energy prices. So markets have been broadly concerned around fiscal policy, the loosening in fiscal policy, which is coming with monetary policy also relatively loose compared to its peers, its global peers. And that fiscal monetary mix has been quite stimulative, which in general is a fundamental reason for currency weakness. And so the timing of the intervention is notable here because it also happens to align with announcements of additional fiscal stimulus, even though those announcements, I think, were expected. Last point on intervention. You always have the sense that FX interventions on their own don't really change fundamentals. That FX interventions are really useful if moves in currency are happening outside of fundamentals or if they're driven by speculators. I think you could argue the latter does exist to an extent. If you look at CFTC positioning, for example, that shows pretty extended yen short positioning at the moment. But I think it's hard to argue that the moves in dollar yen until recently had been strictly out of line with fundamentals because the dollar had been strengthening against pretty much everything, including the yen. We've gone through periods of FX intervention where dollar yen has moved sharply lower, but then retraced those gains because this intervention does not change the fact that fiscal policy is in a very expansive posture. It doesn't change the Bank of Japan necessarily. You'll know what they said by the time you listen to this. It doesn't necessarily change those dynamics on the ground, doesn't change those interest rate differentials materially. It doesn't change the situation in Iran and Japan's exposure to Hormuz-related oil and concerns around potential future escalations. And so FX intervention, we've had periods where intervention has been seen in the market as perhaps a buying opportunity for dollar yen, and we'll see if that remains the case here.
Yeah, really interesting what you're saying. I think a lot of the time we think FX intervention is always acting against the market, but actually that the MOF kind of strategically used kind of yen strength to actually push it further. And just kind of in the aftermath of that Fed decision, which was obviously seen as dovish, what were your main takeaways? And do you think the market really interpreted it correctly?
I think the market is trying to find out who the real Kevin Warsh is. And we have two meetings now where it feels like we have two very different interpretations of how Warsh sees the mandates for growth and inflation, how he plans to approach policymaking. The June meeting was seen as universally extremely hawkish relative to the baseline. That Warsh came out with a pledge for price stability. He was clearly very concerned around the inflation side of the mandate, and that there was a clear hawkish reaction. So much so that the market came into this meeting with uncertainty over whether or not the Fed would actually hold rates. There was about 30% chance of a rate hike priced into the market at meeting time. We felt, and we were in, I think, an overwhelming consensus of economists believed that the Fed would leave rates on hold on Wednesday, which they ultimately did. But the market we really spent the last few weeks wondering and romancing the idea that Warsh is maybe more hawkish than sort of the commentary from, say, economists or maybe coming from the White House may have been letting on, and that he would take a big step towards maybe trying to defend credibility, towards enforcing his mandate, his recommitment to price stability by hiking rates today, or maybe by being maybe a little bit more open to signaling that future rate increases could be coming. We know that Warsh is very disfavorable of forward guidance at the moment, but I think the market was thinking this could be a moment where Warsh kind of eschews something a lot more hawkish and maybe convinces the market that he actually is a more hawkish actor. Instead, I think we got something quite a bit more dovish. At a minimum, what we heard from Warsh is that the conditions on the ground were not yet appropriate to hike in his view. Now, in the view of 3 of the regional presidents who dissented in favor of a rate hike in July, there is clearly a groundswell of some who believe it's appropriate now to raise interest rates. But Warsh was not among them, and media participants, to their credit, did their best to try and get Warsh to explain what specific conditions that have happened in the intermeeting period have allowed Warsh to feel comfortable staying on hold. he really was cagey in his answers there. For example, he was unwilling to point really to the data. He was kind of dismissive of the idea that lower inflation in the intermeeting period was a big driver of the decision to stay on hold, even though I think certainly the conventional wisdom was that, going back to Waller's speech from a few weeks ago, right, when Waller said, if the inflation numbers are hot, I will consider voting for a hike, and if they're not, I probably won't. That was kind of the conventional wisdom, was that, hey, this data probably gave the Fed some breathing room. Warsh rejected that argument. So I think that, again, maybe reduces the market's ability to translate changes in data to changes in reaction function. Warsh welcomed that. He welcomed this idea that markets will respond to data, and he welcomed this idea that there should be uncertainty in how the Fed approaches decision making. The other thing that Warsh put a lot of emphasis on was moves in financial markets. He was very complimentary and very seemingly happy to see that markets priced in a significantly more hawkish direction over the intermeeting period. And he seemed more than happy that markets priced a 30% chance of a rate hike despite it not being delivered, which is a big difference from what we're used to from central banks, who put, in general, over this period of forward guidance, have put a lot of focus on ensuring their reaction functions are well understood and that changes in data are well translated into market expectations for policy. And I think the market's takeaway from this big focus on markets was that Warsh seemed to imply, either on purpose or by accident, that the market tightening in financial conditions, particularly in the rates market, was sufficient to stave off the need to actually increase interest rates from the Fed. He made the point kind of explicitly that while you can interpret the Fed decision as on pause, the market's not on pause because the market had adjusted. And so I think there was a palpable sense, certainly in my conversations with clients and with others, that perhaps the Fed felt that changes in financial conditions are sufficient to cover the Fed, that they might not need to raise interest rates. And so I think the market suddenly finds themselves in a position where it's hard to get a sense of what will happen in September, because if financial conditions stay tight, then maybe the Fed doesn't need to go. But there's circular logic here, because if the Fed, the only reason that financial conditions have tightened is because the market assumes the Fed will go. But if the market has to break that assumption, then financial conditions could, in theory, loosen. We haven't seen that quite yet. If anything, financial conditions, if you look at the long end of the interest rate curve here in the US, have actually tightened because long end rates have gone up. And I think there's a broader sense of, we're not sure how rate hikes play into Warsh's reaction function, because he talks a big game about reestablishing price stability, but it's not obvious that the old reaction function we're used to, which is that certain conditions will push rate hikes, that changes in data will push rate hikes in an intermeeting period, we're not yet convinced that that's something that Warsh actually subscribes to. Again, I think we're trying to learn what Warsh's reaction function is. And I think the market got surprised by how little hawkish sort of follow through we got from Warsh on Wednesday compared to how the market had been repricing. And so you take all that together and say suddenly it feels like there's a bit of a credibility question, that maybe the Fed is in a position where even if data are stronger, then they might not be in a position to increase interest rates. That's a big change from where we were just a few days ago. And you don't want to put too much into one meeting. But as we see it, this all comes back to the data, right? What Warsh says and doesn't say really won't hold any salt unless the data support or move against it. We do think the data on balance are probably going to move in the direction of not hiking interest rates at the September meeting. As we mentioned on this podcast, we continue, our house expectation is that U.S. inflation continues to move lower over coming months. And so we think the Federal Reserve, I should say core inflation, moves lower. So we think that's going to give the Fed cover to not deliver any interest rate hikes this year. So we think the case for steady rates is going to be emboldened by the economic data. I think we're in a period now where the Federal Reserve is encouraging the market to price in extra uncertainty. And that extra uncertainty feeds into the kinds of moves, higher risk premia and long-term interest rates, higher risk premia around specific Fed decisions, a greater sense of uncertainty about what the Fed will actually do and how it will interpret data. Warsh is encouraging in that. And it creates a very different situation for markets and I think for the dollar as well. Maybe I'll turn it back to you now, Eimear, because I do want to ask you specifically about China and the Politburo meeting, because we talk a lot about major currencies here, but China in particular has been a really important force in terms of global markets, whether it be their input into oil prices, because it's such a huge demander of oil. Whether it be into economic conditions, local conditions, how their export performance feeds into economic conditions in other economies and major economies. So I want to start with the Politburo meeting. What were the main takeaways there, you think?
Yeah, for me, there were definitely three main takeaways. So I would say the first thing is that there was no new policy stimulus, only really faster implementation of already announced stimulus. So they said they would accelerate already announced fiscal spending. They would also fully utilize already existent bond funds. The kind of market reaction to this was broad disappointment, which was very evident in the bond space. Remember, we've had Q2 GDP, which undershot the lower bound of their target range. And we also had June inflation, which basically also fell back to 1%. The second thing was that the emphasis was definitely on fiscal policy, not monetary policy. So overall policy, was definitely on an easing bias, but definitely there was a reluctance to enact any kind of monetary policy, whereas fiscal policy, was described to be more proactive. And I guess third is really the policy importance that China's putting on winning the US-China tech race. If you look at kind of what sectors of the economy got the most lip service, it was definitely advanced tech. So it was stuff like, increasing AI governance, breaking the next frontier in technology, really driving innovation and kind of doubling down. I guess the thing about that is that it actually comes at the expense of other areas of the economy. What's clearly emerging in China is a two-speed economy, where the kind of new economy, advanced tech, advanced AI, that's powering growth, that's powering profits in China. But what's lagging behind is the old economy. Furniture, textiles, general manufacturing, they're all seeing sharp contractions in annual profit growth.
That's interesting. You talk about this sort of old and new economy. You can almost make the same case here in the U.S. Very much apples and oranges. The structure of the economies are very different. But here in the U.S., we're also considering how much of this AI build out, this significant increase in capital expenditures, how that's filtering in, how that's maybe a buffer against weakness in other parts of the economy. I feel like, you talk about the sort of businesses and tech of the future being such an important driver of growth, and how that interplays with, the rest of the economy, the rest of the real economy is super interesting to hear from the China side as well, because I feel like we are discussing and debating those same drivers here in the U.S. and certainly in asset markets, AI and big tech stocks versus other sectors. I think is a big source of discussion in global markets and not just in China. Do want to ask you about international trade. Any progress in terms of rebalancing international trade coming out of these meetings?
Well, the biggest thing for international trade when it comes to China is always domestic demand. And on this, I have to say the silence was deafening. So we got one little comment about, boosting domestic demand via financial tools, supporting domestic demand. But there was nothing concrete, no kind of, demand side measure to really get demand growing. For example, if we had subsidies for elder care, subsidies for childcare, culture, tourism, any kind of expansion of the subsidy trade-in scheme, that would have been some kind of positive sign. The policymakers are focused on it. But we got nothing to say that China was really building out that social safety net, which would stop the very elevated levels of precautionary savings in China. And really without that, that means that imports will really just continue to stagnate, which gives very little hope for, China's main trading partners.
So can I ask you to summarize here at the end? What do you think this all means for China policy in the future?
Yeah, so in one way, I do think Chinese policymakers are right. They have ample fiscal space to really actually achieve their growth target. So I think it's 6.8 trillion in unused new government bond issues. They've got 800 billion in terms of this new policy-based financial instrument. So, with that, if they achieve their, budgeted deficit for this year, it will add about 0.3 to 0.4 percentage points of growth. So while this may have underwhelmed market expectations, I think the message we're getting from policymakers here is that it is about growth stability as opposed to kind of reviving or reinvigorating growth. It's just about meeting that policy target. I think really the only way we're going to get, very broad new stimulus measures coming through is that there is a real risk of deflation, which doesn't look to be on the cards right now. Obviously the risk for China continue to be that they have such incredible overcapacity in their industrial sector that prices are being, pushed down with aggressive competition, debt overhangs at the local government level, and also the property sector correction. So I think given these concerns, policy will continue to be kind of slow, incremental, but really ensuring stable, steady growth. But that is probably all we have time for today. Guys, thank you so much for joining me. We have definitely covered the world. If you did like the podcast, please do click like and subscribe so you get the latest episode first. Thanks again.